Is all the news regarding Deutsche Bank going to lead to the next financial crisis? Those are some rumors that are out there. We're going to discuss that and more today on Investor in the Family Radio. Thank you so much for joining us. My name is Brian Bain, and I'm your host. And at Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we're going to make the best investments that we can. So thank you so much for joining us. Remember, our goal here is to help you learn to invest financially in all of life. That's the purpose of all of our podcasts and all of our content. Regardless of the subject focus, we want to use this stuff to help you become a better investor by learning from other investors out there, including myself, hopefully. And you can always find more at investorinthefamily.com. You can subscribe to the podcast at iTunes or the Google Play Store, as well as on Stitcher. And also, if you want detailed show notes from today's episode, my notes that I wrote up or that I took down, depending on which show you're listening to here, then you can get that for free. Text the word family notes, one word family notes, to the number 44222. Or you can go to investorinthefamily.com and sign up there. We'll make sure and get you an email with links to all of the bonuses that I've given away, as well as all of the show notes, detailed show notes that I've created starting a few months ago. Depending on when you're listening to this. That's the beauty of evergreen podcasts. So this is early October 2016. And today I'm going to be talking through Randall Forsyth's Up and Down Wall Street article from Barrons magazine. And again, this is for the week of October 2nd, 2016. The title of Randall Forsyth's article is Too Big to Fail, German Style. And so as you can imagine, it's almost all about Deutsche Bank and the big news we've been hearing over the last few weeks regarding just different concerns, which I'll discuss here. So basically, the big idea is that Deutsche Bank equity and debt securities last week plunged after reports that, quote, hedge funds had withdrawn money held as collateral at the bank for their derivatives, transactions, and other positions. So that's one of those quotes that if you're not, I guess, spending a lot of time on Wall Street like me, you hear that and you think, all right, so I'm assuming that's a bad thing. Because when you get into a lot of the derivatives and other extensive dynamics of big banks like Deutsche Bank, it just gets really, really complicated, and honestly, it can be hard to understand. But to many investors, this sounded very Lehman-like. You remember Lehman Brothers from 2007, the big U.S. investment bank that went under and helped tip off the financial crisis of 2007 through 2009. Fortunately, I guess, Deutsche's chief, John Cryan, Cryan, I'm not sure how you pronounce that in German, but to me it looks like Cryan. He has said that Deutsche Bank has strong fundamentals, and the reports of hedge funds that pulling their capital, they aroused unjustified concerns regarding the bank. On one hand, I think, oh, well, that's good news. Other hand, I think, well, what else is he going to say? So, according to Deutsche's chief, things are fine, but time will tell. The Wall Street Journal reported that some of the hedge funds who pulled money also handsomely profited from shorting Deutsche Bank stock. So, you'd have a situation where obviously those people were, they were benefiting from Deutsche Bank doing bad, and they had the ability to negatively influence the bank, and so there is like a win-win for them. So potentially a little bit of foul play there, at least in my opinion. But bottom line is, according to Mr. Forsyth, is that Deutsche Bank was not and is not going to fail. If there ever is a bank that is too big to fail, you remember the term TBTF, too big to fail, from the financial crisis here in the U.S., Deutsche Bank would absolutely qualify as a bank like that. So if there was some kind of funding issue with the bank, certainly the government or others would step in to help out. Of course, that does cause some problems as well, since Deutsche Bank is, surprise, surprise, a German bank. And Germany has been very reluctant to bail out banks in Europe via the ECB and like with Greece and otherwise. So it'd be really difficult for them to, given that track record, then jump in and want to bail out their own bank. That would probably look kind of bad. Another factor in all this is the U.S. Department of Justice has talked about a $14 billion penalty against Deutsche, which factors in all these concerns as far as their capitalization and their overall financial standing. But according to the article by Forsyth and sources that he quotes, that $14 penalty really is not realistic at all. And so the likelihood of that being enforced at that level, some kind of penalty may indeed happen, but at $14 billion mark is very unlikely. And even raised the question of why $14 billion? It seems kind of random. And perhaps coincidentally, perhaps not coincidentally, very close, almost identical to the number that Apple has been fined for tax purposes by the European, I guess the EU. So any similarity there? I have no idea. Seems kind of random to me, but perhaps it's not. But with all that being said, the big worry is Deutsche Bank's $60 trillion of their $60 trillion derivatives book. And again, this is when you get into derivatives and numbers of that size, it can get kind of confusing and hard to know what to do with that if you're like me. But basically, so the big worry is Deutsche's $60 trillion derivatives book, which is basically, it represents the gross exposure of the bank's contracts. And someone is quoted as saying, Deutsche Bank's net exposures are sufficiently large to blow up the financial system. So you can see why some people could be concerned if Deutsche runs into capitalization problems. And when people heard that hedge funds were pulling money out of Deutsche Bank that was used as collateral for the derivatives, you start thinking, oh my goodness, is there something going on we should be worried about? And is there a possibility that their $60 trillion derivatives book could blow up? And so that's basically the big issue behind the Deutsche Bank story as of now. This is Monday, October 3rd, 2016. And it sounds like, to me, it could be a really big deal, but it may not be a big deal at all. It doesn't seem to be the major crisis that it, I guess, potentially could be to me, but that's all just my perception, and really none of us know. And it's going to be a matter of time to really get a feel for what actually is going on and how big of a deal is it or is it not. But either way, something weird is going on there, and we'll wait and see what happens. As far as how this may matter for the rest of us, all this, first of all, obviously, if something bad happened there, it would affect all the financial markets, and that would be bad. All this could impact U.S. homeowners via interest rates, which is kind of a twist I did not expect on this. And there's a discussion about dollar funding and things like the carry trade or carry trades. Again, these are financial terminology that you may or may not be familiar with. And I'll have several links to some further discussion and definitions for some of these terms. If you, again, sign up for the show notes package I mentioned earlier, text the word family notes to 44222 or go to investinfamily.com and sign up for the email list there. And I have some links and a few explanations on what dollar funding means and what a carry trade is. Basically, the basic idea of a carry trade, and I'll use an example. Say someone in Germany, say a business in Germany wants to fund a project, but they borrow money in US dollars from a US bank for some reason. That was where they found the best deal. So they borrowed money in dollars. They convert those dollars into euros to conduct business in Germany. And that's all great as long as the euro and the dollar stay pretty much on par. But if there ends up being a significant discrepancy in terms of one of those currencies rising or falling in value versus the other, then the carry trade could become a significant issue in terms of, okay, well, that company in Germany, if the dollar keeps getting stronger and stronger and stronger against the euro, that means it's going to be a lot more expensive for them to pay back their debt in dollars, if that makes sense. So that's an example of a carry trade and why changes in currency amounts and exchange rates can become an issue. As far as the phrase dollar funding is basically in that sense, that is dollar funded. That company was borrowing money in dollars, so that was dollar funding going on, as my understanding of this goes. And so the way this comes back to the Deutsche Bank stuff and U.S. homeowners is that funding costs or rates, the rates to fund projects or get dollars basically for European banks increased due to some of the stuff going on to Deutsche Bank over the last week or so. And this has caused increased demand for dollars at low rates, because if the rates to get euros within Europe are higher, then you can look to the US to get dollars because rates are better in this case. And then you add to that the fact that in mid-October this month, US money fund reforms are set to go through, which have already been pushing up short-term rates, most notably LIBOR. You're familiar with that term. And LIBOR is the basis for many U.S. loans, including mortgage rates. So if LIBOR goes up, that means interest rates on many U.S. loans go up. That means mortgages go up. And that can have a significant impact on people's monthly mortgage payments, on what they can afford housing-wise, and so on. A small move here or there may not be a big deal, but if rising LIBOR rates do indeed impact housing, that could put even more stress on the Fed to not raise rates, or at least be slow or even slower in raising rates going forward, just adding one more reason of concern about the economy and not wanting to do something right now, aka raise rates that could cause any more upheaval or concern or issue in that regard. On that note, Bloomberg is saying currently there's a 59% chance of the Fed raising rates in December, but the odds are very much against the chances of rates increasing in 2017 at all. So basically the idea of rates increasing another 0.25% probabilities are pretty good, and they're also pretty much just as good that they won't raise any higher above that in the foreseeable future. So basically, in summary, the Deutsche Bank situation has the potential to be a time bomb, but fears seem potentially overblown, still to be determined. I want to give an answer, but I can't. Dollar funding and U.S. money fund reforms run the risk of increasing interest rates and impacting mortgages or via LIBOR, and pressuring the Fed to stay slow with raising rates. How is that for a mouthful? So what does this mean for us? It's another reminder, again, these are all my personal opinions, make your own decisions. Another reminder that at present, that economies are struggling, central banks rule the investing world. So again, that economies are still struggling in the U.S., in Europe, and globally, and central banks rule the investing world. As far as what they're doing with rates and monetary easing is really what's driving so much of the markets. That's not a new idea, but it's important to not forget that. Is any of this a reason for panic? Not in my opinion. Reason for ongoing caution? Yes, I believe it is. As I've been reading back through The Intelligent Investor, the ideas of Benjamin Graham talks about simple portfolio balances of either 50-50 stock bond or 25% bond, 75% stock, or vice versa, 75% bond, 25% stock, depending on how overvalued or undervalued the markets are. And by pretty much by PE measures and probably any reasonable measure, I think it's very reasonable to say that the U.S. markets are overvalued right now, which tells me there could be good reason to be in I don't like to get in the stock equity exposure or the bond equity. I focus more on cash equity, cash stocks. So a 25% cash, 75% stock exposure could be really wise right now. And if you're really concerned, then maybe make it 50-50. If you want to do that, that's all up to you. I always say, don't follow my investments, do your own work, because I make lots of bad decisions. But hopefully they are getting better, as I hope yours are as well. As always, thank you so much for joining us on Investor in the Family Radio. If you want the show notes or my notes on this article and my talking points from today's show, text the word family notes to the number 44222, or visit investorinthefamily.com and sign up. We'll be sure to get you taken care of. And also remember, you can always subscribe to the show at iTunes, Stitcher, or the Google Play Store. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.